All right. Hello, everyone. Good afternoon, and welcome to the fourth episode of the special COL webinar series entitled Investing in Today's Market Volatility. This webinar was created to help investors like you learn how to navigate the stock market in the best way possible. So we understand that lately the market has been very volatile, and there's a need for guidance from all levels of our customers. So this webinar is for you guys. I'm Ed Martinez. I'm the head of COL Premium, and today I'll be facilitating our interesting discussion with our expert, which is Mr. Juanis Barredo. All right, so before we proceed with the presentation, I'd like to discuss some important reminders to ensure that you'll have a pleasant and smooth webinar experience. First of all, let's first make sure that you have fast and reliable internet connection. There should be at least a 5 Mbps of internet speed, or your 4G or LTE connection in your mobile device is very much encouraged by GoToWebinar. Okay. Secondly, avoid opening multiple windows para you can dedicate your computer's processing power to operating the webinar. And third, you guys are on listen only mode, as the lady suggested kanina when we started. So it's best to use your earphones or headphones to have the best sound quality. But of course, this does not prevent you from asking questions. So if you have any questions, you can just go through the questions poll, the questions tab in the right side, and then ask us a question so that we can note it later to be answered by our expert. And today we're also going to be using the new feature, one of the new features of GoToWebinar, which is polling. So this poll allows you to, answer a question that we will, of course, use or interpret your answers. Okay, so to have a short demo, can we please have the first question and please be ready to answer it as well. Oh, our quick sample poll is, what are you most looking forward to once the ECQ is lifted? Yan. One, are you excited looking forward to travel? Are you excited to go and eat out? Yan, yung mga nasasawa na sa pagkain sa bahay. Third, go to a spa. Ito, suggested ng kaibigan ko to. Fourth, shop. Or fifth, you'd rather stay home. Yan. So please stick your answer. And in a few minutes, we will reveal the percentage of answers from all our attendees. Okay? So, yan, choose lang. Are we gonna travel, eat out, go to a spa, shop, or stay home? Okay? Sa ating 137 participants, kindly answer the quick poll. All right. I think there's already an answer. Can our staff please reveal the answers? Ayun. All right. 31% of you says you're gonna stay home. That's the majority answer. Well, actually, that's also my answer. And a second, of course, answered to travel at 30%, 26% to eat out. Unfortunately, wala masyado nag-shop and walang masyado nagsa-spa. So there you go. That's how the polls operate. Now let's ask you guys another question, which we will use later on in the presentation of Mr. Barredo. So can we please put up the poll? All right. Again, click what you think is the best answer. What is the shape of recovery do you see in the next 8 to 12 months? Is it a V shape, a sharp drop, then quick recovery? A U shape, a long recession, meaning a sharp drop and then a slow recovery. Next, a double dip. You know, if it drops, then it recovers, then drops again, close to the previous support, or an L shape, a steep decline and a very, very slow recovery. So what do you think the recovery will look like in the next 8 to 12 months? because this will actually determine what your action is going to be moving forward, di ba? Different types of recoveries will result to different actions that you can make to make the best use of your portfolio, di ba? And later on, I hope Mr. Barredo will also share with us his thoughts on what shape the recovery would take in the next 8 to 12 months. Okay, in a few minutes, we will reveal to you guys the answer. All right, is it a V, a U, a W, or an L? Okay, do we have an answer? Ayan. So according to our poll, 35% of you guys, 46% expect a double dip, then a full recovery of the market. Or 35% expect a U-shaped recovery, a long recession, then a slow recovery, while a minor percentage thinks that there's an L and a V-shaped recovery. All right. So thank you very much for answering that. That was very useful to our presenter, which I will introduce next. Without further ado, ladies and gentlemen, I'd like to introduce to you our expert who's going to conduct the webinar this afternoon. He is a five-time Best Technical Analyst awarded by the FMAP, or the Fund Managers Association of the Philippines. Ladies and gentlemen, with 30 years or of experience in the market, our Chief Technical Analyst, Mr. Juanis Barredo. Go ahead, sir.
Hello, Ed. Hello, everybody, and welcome to another episode we have. A few weeks ago, we decided to be able to look at the market when it was falling down quite quickly, and we were looking for a prospect of a particular bounce to be able to come into effect, and sure enough, we did find the bounce that the market was able to push on. So far, we're still in that rebound mode, and I really hope that some of you were able to be able to capitalize on this particular event. And I'm sure maybe not everybody, because normally things like this can catch people off guard, and unless you're prepared for it to happen. And so now that we've been in this rally mode for a few weeks now, let's try to be able to get in hand on what we're going to be doing next. Because what happens after recovery? Is it something that will just continue on and on? Is it going to be straightforward? Or do we have to anticipate something to come in between that we have to get ourselves ready for? So today, let's try to be able to understand a bit more what's coming up next. And so let's ask that question again, what's next after this oversold bounce? All right, so the condition of the bounce is actually quite plain vanilla. I mean, normally when companies attempt to be able to fall down at the sharpness that they did, as soon as we notice some degree of laxness into the selling, then the market had automatically managed to be able to generate that rebound. The picture you're seeing here is actually a picture of percent performance of some of those indices that we've been tracking. If you notice here, Shanghai is on top, S&P 500, followed by the MSCI Emerging Market Fund Index, followed by the MSCI World Index, and down here, of course, the Philippine Stock Exchange Index. Now, although we may be in the last area here, do understand that we did come from a very, very steep drop. Our index actually fell just over 40% in terms of a drop on this year alone. And the recovery we've seen has reduced that now to somewhere closer to about almost 26% in terms of a decline. But in general, we've seen a nice and healthy rally from many markets right now. We hope there could be a little bit more for this to put out, but again, we have to be prepared for this and try to understand what was this all about. Why did this rally? And does this rally mean things are finally back to normal? Because we do have to understand that markets are always pricing things ahead in the future. So the price that you're seeing today is trying to be able to factor in things that are coming, not that things are happening right now necessarily. And it's because of that that the market attempts to respond what seems to be way ahead than what the economics or the reality outside is starting to show us. So let's have a look first at what's going on into some other markets, particularly the US, because this seems to be what's guiding a lot of other markets right now. And we're looking at a very long-term chart here for the S&P 500, just so you can see the scope of the decline that we've seen in the short term, and also where it actually happened to be able to fall down to. So if you look at this monthly chart of the S&P 500 here on the left, you would see a very striking decline closer to 3,393, falling all the way back down closer to 2,400 level. And of course, it was an intraday breach, but it managed to be able to close back above this major trend line that I've drawn inside. And I would assume that this area would still remain to be a very important support point for the US market or the S&P, being at 2,400. If this actually breaks again, then there is a possibility that might try to be able to retest that 2,200 zone. But I really hope that this 2,400 zone can actually hold for the meantime and try to be able to provide enough support for prices not to fall below that. Here on the right side, I'm showing you the 10-year bond yield in the US. Now, what I wanted to point out over here is that you can clearly see from since 2000 that the price of bond yields in the US has really been trending downwards. Yes, there was a bit of a rally coming off from 2017 to 2019, but that was shoved down very, very quickly as we come towards the beginning of 2020, and so much so that it fell all the way back down, coming closer to the lower end of this price channel. Now, why I'm pointing this particular instrument out really is because this is trying to show you how exaggerated things have become, because they've had to be able to maneuver this rate or bond yields down to be able to reflect how fearful society was. And given that we've come pretty much to the lower end of that boundary, that already tells you that the magnification of fear has really come off to the nth degree. And I really hope that that particular type of fear generation is also coming along to telling you that the market may have already come to the degree of exaggerating itself. And what we need now is a period of stability to come back into the equation to be able to help prop things up moving forward. Now, to be able to look at the impact of that onto a few other things, let's look at the US dollar. The US dollar has also managed to be able to make pretty decent recovery. And you're probably wondering, why is the dollar getting stronger in an environment like this? The US is one of the countries hard hit also by COVID-19. But the reason for that is because a lot of the other currencies that this index tracks itself against is actually weakening faster than the dollar is. And it's because of that that the dollar managed to be able to make this type of recovery. But I think we'll be coming towards a major resistance point for the dollar. So I think you probably see some plateauing coming here very soon, and that the dollar index you see here may start to be able to slowly curve as well. So hopefully that can keep things contained and not put too much pressure on the other currencies as well. In terms of being able to see other instruments like gold and oil, we have gold here in the centerpiece, and you can see that gold has been also in a striking advance at the same time. It's also coming close to a very major important resistance boundary, which is standing closer to about 1780. And this area, I think, will prove to be quite resistant for gold. So we might also anticipate that there could be some tapering off coming here as we see that the major highs for gold is coming up bad. Finally, let's look at the damage in oil. Well, as you can see, because of the curbing of a lot of local businesses, airlines have been shut, a lot of travel has been put off, people can't be driving too much anymore across the world, and obviously all of this took its toll into oil prices. And you see the price of oil have fallen all the way back to almost $20 per barrel. In that context, it's also showing you how exaggerated things have become and how magnified in terms of fear things have become. And this is a major support point for oil, since last time it was there was way back here in 2002. And I would assume that this area here would prove to be quite supportive for prices. And so let's see if prices will attempt to be able to hang on here. And if that can actually generate some sort of recovery plan for oil, that also should be able to lend a hand in generating recovery plans for the other markets as well. All right. Now, let's have a look at what happened into the Philippine market. So in terms of the Philippine market, you want to be able to see a long-term perspective of what's happened over here. We're a little bit different in terms of stages of where we are in the US. Now, I think in the Philippine market, we've had a nice big high here coming towards 2018 and 19, and then we see a first fallout, a recovery that did not come back to the previous high. And now that was set a lot of warning bells already. And once a supportive area over here started to crack, and you see that the fallout took place primarily also instigated because of what was happening into this virus pandemic, we've had quite a bit of a nasty fall. But if you look at where prices had fallen to, they've actually hit the 50% Fibonacci level already. That means it's lost half of the value of this rally that it's seen from 2009 all the way up to what we saw in 2018. Given that context, markets normally tend to be able to generate some degree of support when they've seen that quite a bit of pull down is already taking place. And usually if you see ranges of about maybe 38 to 50%, that should be able to express its first level of demand action. And just in case if there will be a bit more, then maybe even come down closer to the 61.8%. So, but this is only if things really get bad, and that major support would be closer to about maybe 4,500. But I hope that we've actually factored in many of these things. I'll talk about this a little bit later, and I hope that that support point that we've seen so far can actually carry itself. Looking into the Philippine peso, if you actually look at it, we've actually pulled back a little bit here, and that means that the peso was actually gaining some traction against the US dollar. And we've not really seen it lose its value, unlike many other Asian currencies. So the peso seems to be quite sturdy in that stand because it's actually been moving sideways, maybe coming off from a high band of about 51.70 and a low band of about 49.70. And it's been trading in that range. And I hope things can continue there. But let's see what's going on. I mean, the Philippine government is now pushing a lot of stimulus efforts here, and they're throwing some money to be able to help out. And let's see if this is going to be able to affect the nature of the peso soon. But so far, I've not seen any particular change so far. So we'll keep the consolidation band in view for the meantime. Now, last time I've actually met with some of you using this last webinar I did about roughly 4 weeks ago, I talked about that the Philippine market will go through 3 technical stages. And these phases or stages that we're going to run through, I just want to be able to drum up again so that many of you can be quite ready to be able to understand the phases we're going through, so that can also best prepare you for what to be able to be seeing into the short term. So normally we go through a period of what we call selling capitulation. That's this massive fallout in prices, which we've recently seen. And normally what you're probably asking, why is the market falling so fast? It seems to be quite unreasonable. Well, the reason for this is because, like I said earlier, the market's trying to factor in what it is anticipating. And as things are getting from good to bad, a lot of people tend to throw everything in the kitchen sink into becoming quite a pessimist. Of course, as the virus came in, we didn't know what to expect at first, but finally, when things started to hit us, and especially when the lockdown came in, that's when reality started to knock on the door, and that just took the floor off stock prices, and that's why we've had a very, very sharp decline. We call it a capitulated decline because emotion comes inside to drive that move. After that, we go through what we call a recovery rally, which is something that we're seeing actually today. Now, in that recovery rally, usually that will come in 2 phases. First, you will get this rally or the oversold bounce. After an oversold bounce, it will attempt for prices to come back a second time. So if you look at the picture that I have down here, this is what the capitulation looks like. A recovery rally or an oversold bounce will look like this. And then there will be another attempt for the markets to likely come back and test that low. It may not go all the way to the previous low, and I really would hope that it wouldn't be. I hope it'd be something more like this. But I think a higher low will probably come out after this, and then, of course, show you a bit more robust ability for the market to be able to stand on 2 legs, so to speak. And so what happened? Why is this market making an oversold bounce right now? Well, in recent days, you've probably been seeing that the narrative out in news services have actually changed. 3-4 weeks ago, people were talking about the virus, the acceleration, how hospitals would get overburdened. And now we're seeing things change. Now people are talking about potential cures that may come up within a year's time or maybe a year and a half's time, or possible treatments that are coming out to be able to help fend off a lot of the hospital cases, or deliveries of more testing kits, or perhaps more breathing apparatuses to make more give a lot more people who are sick a chance to be able to recover. And this comes out to be able to generate that rally. But now as that rally comes on, the share prices will try to make a recovery. Some of them could even go back to maybe not so cheap levels. And these areas, people will now ask, are things okay already? Or could things still become quite difficult into the situation? And this is the reason why markets may come back to test that second movement. Also, after those acts of stimulus or talks of the flattening of the curve or a possible cure, we may also be beset by potential a second wave situation where the virus would come back if, let's say, they release things too early. Or it's quite possible that maybe third quarter earnings could really be quite bad, if not the second quarter, if not, sorry, the second quarter be bad instead of the first quarter. And so I think these conditions could really take its toll into the market and may generate some pressure back in the market after what this rally is like. So it's very important that we stay abreast with the potential of this. After that, the market will recover again. And that will go through what we call a trend reversal because it would have confirmed that support does not want to break. And then you will see higher highs and higher lows come back into the picture, which is a testament that trends have finally fixed themselves and a graduated recovery would likely come out of this situation. And a picture of that would look something like this. I hope that, if one day they finally start to release the lockdown or at least be more selective in the lockdown process, businesses are allowed to go back slowly, and this will allow earnings to slowly stop that bleeding that they're doing and create perhaps the sense that things are starting to get back to the process of normalization. Not normal yet, because I think that might take some time, but you might have the ability for markets to be able to recover. Of course, a miracle could come out and somebody could say, we found a cure, or we found a successful treatment that can treat COVID-19. And that could probably accelerate the ability for the market to be able to recover later. So where are we along that entire phase? Well, I've listed out over here some of the things that we've run through, in recent weeks. Of course, we all started with the question, my God, will this actually even affect the Philippines? In the end, we did. Cases started to begin and started to pick up. Then the travel ban started to begin. Then we started worrying about acceleration in the cases. The 30-day lockdown came into place. Then people were talking about there not being enough tests. They talked about hospitals being overburdened. Then the government came into the picture to try to help out. They gave some handouts. They tried to be able to raise some stimulus efforts, hopefully bring down interest rates. And then, of course, here we are again. We're back in ECQ, and there's a talk of potential extension of this, maybe another 15 days. We don't know. And of course, the prospect of the flattening of the curve is also helping out, which is roughly where we are roughly today. And hopefully moving forward, we'll really talk about what the chance for partial freedom will probably come in. And then if it is a success and we can stave off the effects of the coronavirus, then boom, that should be able to give us a good track to recovery. But if not, and a second wave of infections come about, then we may have to be able to go through another rough period a second time. So right now, we're actually in the flattening of the curve phase. And the reason for that is you can see that the chart here on the right starts showing you already. These are the daily number of cases coming out in different parts of the world. One on top being the United States. You can see other areas in Europe and Asia here on the lower end of it. And what notice you can see that things are kind of flattening down. So that means, yes, we still have new cases coming in every day, but it's not coming up towards that point of acceleration, and that it's tapering off. And that is the kind of flattening of the curve that we want to see to give a semblance that this pandemic is coming under the first degree of control. Now, if we do things rightly and we don't jumpstart this too quickly, we allow these things to be able to come off, then you should have a good exit strategy coming through this, and that could help a lot in keeping things quite flat, if not more on the recovery side. Now, in terms of the stock market, as much as the overbounds that we've seen recently have been very nice and sharp for some people, I think you have to understand that markets tend to bottom, and when this bottoming process comes in, it takes time to do that. It's not just an automatic recovery and up, up, up and away is what we're going to see. This takes time. Now, what we'll do is we're going to try to go to track this attempt to recover by using certain technical tools to help us give a gauge of whether what phase of this technical recovery are we in. Is it something more sustainable now, or is it too early to be able to say that? And what I want to introduce to you today is the use of two basic indicators here, which is a 20-day EMA or exponential moving average compared with its 50-day EMA or exponential moving average as well. If you notice here in the chart of Globe Telecom, which I've tracked back in 2016 going to 2017, a downtrend in Globe was taking place. And you can see that here's a 20-day moving average followed by its 50-day moving average. And there was a recovery actually seen through here. Now, the first impressive signal I want to see is I want to see prices break above both those moving averages. Now, once we see prices break above that, that will be a very important signal for us, telling us that more likely the worst has been over, but now the bottoming phase is now attempting to be able to build itself. This doesn't mean that an automatic uptrend will come in, because what happens after this is that it will settle back down. But what a good indicator I want to see is I want to see the 20-day EMA cross above the 50-day EMA. When we get that crossover, that should be able to signal that enough upward momentum has been generated, and that will allow things to be able to show more smooth types of recovery. If the recovery we're seeing will only go above the 20 and fail to go above the 50, or fail to show a crossover between the 20 and 50-day, then that means that there will still be some time element that the market may have to come down, rewind itself before attempting to make another recovery condition. Let's look at a few samples as I show you different types of bottoming patterns so that you can get a sense of how to be able to use this. Now, I think the three options we are going to have in terms of the market showing a base, we'll describe it by looking at a few letter shapes so that you can best see what the potential for this to look like moving forward. Now, we'll start with the letter U shape, or some others may also anticipate the letter L shape type of recovery pattern. Why letter U? Because if you see the image here on the left side, you will see a decline, slowly, gradually turning around like a letter U, and then eventually starting to work itself upwards. Now, a softer version of that, it will be an L-shaped base. So again, a declining movement, but instead of rebounding relatively quickly, it flattens off and makes a very, very long consolidation sideways. And eventually, the market will recover after that. So whether it's a U or L shape does present that it's a more gradual turnover in time. And an example here on the right side is MegaWorld back in 2009 when it was also coming off a bearish swing. And again, I wanted to use the moving average to point something out. The 20-day moving average following the 50-day, the red one. And if you notice, there was an attempt to rally over here where the price did go above both, but there was no crossover of the 20-day above the 50-day. And so what happened is all it did was generate a sideways pattern, and then it launched it back into a downside. Again, down here, before 2009, there was an attempt to rally. It hit its head on the 50-day moving average, and again, we saw prices attempt to be able to come down. Sometime towards in April of that year, it tried again, and this time it managed to break above both. Plus, the moving average started to cross above the 50-day. The 20 goes above the 50-day. And this is that situation I'm telling you that improves the particular context of the reversal condition. This is what eventually we want to see the market generate for us to tell us that we're seeing more stability now into the market's trend of recovery. And after that happens, and you can see how much more smooth the advance of that particular recovery took place. Now, another type of shape that we could also be beset by is what we call a V-shape recovery. I'll show two versions of this. Now, it's called a V-shape because unlike the U, it falls very, very sharply and then stops and then just climbs very, very quickly. To the point that sometimes it does not even leave an opening for people to be able to buy back. And that's why, V-shapes are nice to see, but it's actually very hard to trade and to participate in because it comes so suddenly, leaving a lot behind that it doesn't give them an entry point to be able to come back into the market. Now, I do hope that a variety of this can actually come up. The other variation is what we call a square root type of a V shape. Again, sharp decline, a recovery, which almost resembles the V shape, but then a consolidation base comes in to generate a potential new strategy for us to enter. Now, this particular type of maneuver, I mean, it happens once in a while, not all the time, but if it does, then it's easier to spot because the consolidations you can see here are very orderly, and that they will very, very less prone to be very, very shaky into the market. And that would be a clue for us that once the market's orderliness comes in, that tells you that that period of stability is coming back in order, and that's what we want to see. Now, example of a V-shape is what happened in Ayala Land. Again, very, very sharp advance taking place into the V-shape recovery after that October of 2001. But again, please look at the moving averages again, the 20-day staying below the 50-day. And as long as it stays below that, the rallies that you see to it are very temporary until one day it breaks over it and there is a crossover between the 20-day over the 50-day moving average. Once you have that, a much more solid rebound is taking place. So again, we're just pointing that fact out so that you can use this later on to be able to guide your hand to be more aggressive when you see those particular situations happen. Now, the final type of reversal is what we call a W-shaped base. Now, it's called a W-shaped base, and you might see a W 2 times here. The first one in the short term, when you see prices will fall down, they will rally, and then they will come back to retest that, maybe even make a higher low, and then try to show a much more longer recovery. And then another retest will come in a second time, and then again make another higher low, only to find out the recovery, a much more sustainable recovery, comes in later. So an example of this is shown in Metrobank here in 2009. Very sharp fall, recovery. Everybody thought that this was it, that things would go up, but unfortunately didn't break above the moving averages, fell back down to retest the low, and then tried to rally a second time. But again, look, the 20-day moving average did not break the 50-day moving average at that period. And because of that, it pulled prices back down to retest that low a second time. And here is that W-type base, only to find out that the rally that came in later was something more sustainable and more prolonged. And again, the crossover of the 20-day over the 50-day is what made a lot of difference. So we want to be able to keep that very much in hand and keep that under our watchful radar. And once we see that, that should be able to give us what we want to see in terms of more aggressive entry strategy. Now, my personal pick is that we're probably going to see a square root or W-shaped pattern into our market. The reason I'm also picking this is because I've already seen the initial rally that we've had, and it's been quite sharp. So it's very difficult for the U or an L shape to come out of that. So more likely we'll probably a square root type of a V or this W base that I'm probably more keen on seeing to be able to come out later on. And so also, if there is a potential threat of an extension of a lockdown or a particular second wave situation for COVID, that could also put in the pressure that we would see that will generate the second low in that W. Now let's have a look again into the short term of the US. So in the US, we've seen a decent recovery, actually a little stronger than we have. After the S&P hit about 2191 low, it managed to recover back closer to 2,874. And it's already gone above the 20-day, and it's gone above the 50-day moving average, and it's now going to challenge the 100-day exponential moving average. However, there's been no cross up between the 20-day over the 50-day yet. So even if this is happening, remember there could still be an undertow here that could pull stock prices down. I feel that the US market is actually generating what we call a B wave recovery. If you probably remember an Elliott wave cycle, a corrective cycle will go through three phases: an A wave, a B wave rally, and a C wave to complete the correction. Now, generally, C waves tend to extend the low of the B wave, but I think that the A wave that we've seen recently has actually magnified fears because of what happened with COVID-19, and I do hope that it actually exaggerated the distance that it wanted to travel, because of which a lot of the corrective impact of that may have already been thrown out and a lot of positions have exited. And so I hope that the B wave that we're seeing is showing itself to be a bit strong because of this exaggeration. And also, into a C wave or another wave to retest at support, it may likely not go all the way below this 2191 area that we've seen. Maybe just come back a fraction of that particular decline, maybe come close to it, but maybe not pull itself all the way back down to the previous low. But I really feel that after this rally is finished, we are going to see a corrective impact into this. So don't feel that we're out of the woods just yet and that the choppiness is going to return once this rally loses some steam. So a potential rally target for that would be between 2,900 and 3,100 for the S&P 500, those being major resistance points. Into the Philippines, let's look at the short-term movement into the index. We've also managed to climb. We have not gone above the 50-day moving average yet, but we've gone above the 20-day. But we seem to be encountering some problems here, and I would anticipate that because we're a little bit different into the Elliott wave cycle. We are not into an ABC, but it feels that we are into a bearish swing, which is a 1, 2, 3, 4, 5, and we're currently running a wave 4 rally. This wave 4 rally is what you're seeing over here, trying to be able to make a comeback. May find heavier resistance closer to 6,100. And if we're only truly lucky, then maybe we can even reach 6,600. But I'm keen to be able to see that the first resistance closer to about 6,100 may be a bit more strong in its resistance pull. So please be watchful of that. And just in case it is, you have to be able to get ready to be able to lighten into your positions. After that, wave 5 movement will come back to retest support. I hope it makes a higher low rather than make a lower low. And then after that, it will recover and generate a base out consolidation. I'll show you what this looks like in a little while. All right. So I took a sample from what I saw the Germany and the Italian index did sometime in 2016, where it too was going through a bearish swing. And just like what you've seen here in the German DAX, with a very sharp decline, then a recovery phase, which is I feel where we are now, and then there will be an attempt for the market to come back down a second time, and then a recovery and potentially a consolidation base that could work up into a higher low. A weaker version of that is what happened in Italy during that same period. Again, a shakedown, a recovery rally, just like what we're seeing today, and then a tapering off. This one went all the way back down and even generated lower low, and then it attempted to build the base somewhere over here. So this could be more L-shaped like because it's more flat. But I hope that the Philippine market could show something more of this particular caliber rather than the first. But this could be a good sample for us to anticipate in terms of potential movement that we have. I will now show you what it looks like with the moving averages in place inside. So again, if you look at the bottom one first, the Italian index, look at the rally. The rally that we've seen only hit either the 20-day or the 50-day moving average, maybe almost up to the 100. And after that, it started to be able to get slammed back down and cast it all the way back down. The German index here attempted to work right through those moving averages, but this was stronger. But look at the way it proceeded along with that rally. It was very choppy. The first part was nice and smooth and fast, and then it went down and up, down and up, down and up, very choppy as it goes through that resistance area. And I think since we're in that area right now, we're probably going to feel the same type of pressure. So anticipate that after a rally, you'll see some volatility, and eventually a corrective move will take place right after that. Now, the correction hopefully can have a higher low, and once we see that, then I think the market should show some more viability in terms of its ability to make a recovery. But it will need a preparatory pattern like this or like this before it engages into something like that. So use this model for the meantime, unless I one day come up and tell you otherwise. This is the model that we're looking at for a potential turnaround from where we are today. So the strategy inside over here is really to be able to understand that we're in a temporary rally. This oversold bounce had a function. Its function was to be able to get prices way out of that incredibly crazy situation it was all the way down there, which is not very facilitating to its fundamentals. Only because people were quite fearful of what was going on. And now it attempted to normalize. And its attempt to normalize, everybody thinks maybe this could be it, the new recovery, and the new bullish swing. Some people jump in, The market moves more than what it should, and eventually a corrective period will come in when a lot more people have bought the market already. So it will look like something like this phase that I've drawn here onto the right. And so the blue arrows that you see are showing you the opportunities where you should be building a position. So the way I want you to do this is, as the market attempts to be able to make a recovery, please don't chase prices. Try to be able to build your positions like you were holding a box of a position, and you will only put it in every time prices attempt to be able to make a correction. That'll probably be the best. And don't have buy everything all in one go. Schedule it. As the prices see a big decline, you buy some there. Happens again, buy some there. Because I think the worst is over in terms of where the low was. All we need now is time and more recovery before this can try to take itself out. Now, when do I kind of add to the positions if I already have one? So if you have a position now, you ask yourself, are you light or are you heavy? If you're light, then obviously you have room to add to your position. So if you do, then every time the market makes a correction, add. When the market makes a surge of a rally, lighten back down to your original. So try to keep a base into your box of maybe 50%, maybe 70% of a position, and play around with that 30 or 50% to be able to sell whenever you have a very, very sharp rally so that you can buy it back every time a correction is made. This market cannot run away from us. The fundamentals are not supportive of it. It can finish its rally, but it may need to be able to come down several times, and we're going to use this opportunity to be able to put our positions back. If you're heavy, then use the rallies to be able to lighten so that you build your base back to somewhere between 70 to 50%. And then every time you see the correction, just simply buy them back or top up into your position. So please don't run after prices. This is the wrong thing to do at this particular time. It's going to take some time before this thing finishes. So today I want to be able to recap with you the 30 companies that we have in the PSEi index. I know you're probably wondering, why don't I cover other issues? Well, I can do that later in the Q&A, but I would rather be able to focus on these issues because right now when the markets are weak, you want to be able to move into a stock that can take in good amounts of liquidity. Automatically index funds will have to buy all these 30 stocks. So at least because of that, you will have good fund flows coming into these issues. And you will not have to worry about a stock falling down without a buyer because there will always be a buyer, especially for these types of index stocks. So my proposition is to be able to build your position base with these issues first. If you want to be more aggressive, maybe you can splice off 20, 30% of your portfolio and you can allocate it to whatever other speculatives that you may want to be able to do. So for the meantime, what I did is I gave you a cheat guide here. I drew out every index stock you have, and I marked out what the first and second support areas would be for each of them. Now, the reason I want to be able to look at it in this manner is really because we want to be able to generate our ability to see where the entry spots would be. I'll just fix this first one because I probably didn't enter the right figure here, but I'll fix this in due time. So resistance means, what is my upside target? If you're seeing a rally today, what would be an anticipated area to be able to encounter some resistance area? So let's say in Ayala Core, 612 first, and then 669 would be the next area. I'll go through each one of these companies so that you can see how each are faring, and that I'll mark out to you where the potential selling areas would be. So let's begin with the first. So Ayala Corporation actually had a pretty decent rally. It's actually hitting its 61.8% Fibonacci level. And it's really because of that I want to be able to mark off some degree of resistance coming close to where we are. And that's closer to about 612. If it passes this, then maybe extend back to 669. This is where the next moving average is actually standing. So you should be getting ready to be able to start lightening on this already. I mean, I would say that this may be the wrong time to be entering this. So I would be more in favor of waiting for a reaction rather than an entry. And I will just follow the same thing I'm doing with this. Again, please forgive me. I will just fix my first support price here to be able to recalibrate this, and I will send an update to you in the new slide. AEV, AEV managed to be able to make quite a strong recovery as well, and so it's made its first pullback. I feel this will probably generate a consolidation first in between the high, the range that you've seen here. This is closer to about 49. Low end zone, I think, would be closer to maybe 41 first support and maybe 36.50 being the second support. AGI. So AGI didn't really rally too strongly, and perhaps this could be because it may have some casino businesses that it's also tracking and some businesses that are also getting affected because of the lockdown. And it's really because of that, I think that they're probably underperforming. But it's almost hit its first target at a 38.2% recovery rally. This should present resistance closer to 660 into that area first. And then we'll work up into the next one after. Ayala Land, I think, seems to be losing some steam into its rally already. So some of the rallies that you will see may make patterns like this. And what I mean by that is that you'll see the first move, attempt to come down, retest the high, failing to go above it, correct one more time. Now I know it's making a bit of a rally over here, but I'm quite watchful that more corrective interest will probably start coming here. So you might want to start already your lightening program with Ayala Land. And just in case it extends, you probably want to do that closer to about 35 to 37 in terms of the lightening, if not already now. Then we have Aboitiz Power. It also made a decent recovery, but I think it also built into a consolidation pattern right now. And I think there will also be some pressure for this to be able to come down soon. Resistance will be closer to about maybe 30, which is the high that it made. The next one will be about 32.50. But I'm a little worried already that there seems to be some pressure building quite sooner than later. Could be because Aboitiz Power rallied first than the rest. And so just be watchful potential there. And momentum seems to be slowing down as it is. BDO is also into a recovery phase. It managed to be able to hit its 20-day moving average so far, and seems to be encountering some pressure as it is. I noticed a lot of the banks were also being downplayed into this rally. It could be that people are worried about the potential loans that they have and how the lockdown in businesses may affect their holdings into these banks' portfolios. So that could be the reason why we've been seeing quite a bit of a slowdown or a slow rally into this. So first resistance has pretty much been hit at 110. Next one should be about closer to 118. So be a bit more careful with the banks. Bloomberry seems to have flattened off from its recovery. This doesn't really look too shabby as of yet because the 20-day moving average seems to be holding quite strongly. That resistance is closer to 620, and just in case it manages to punch through this, the next one would be closer to about 690. So again, another potential lightening situation to be able to watch for here. BPI, just like the bank I told you earlier on, also generating a consolidation at its 20-day moving average. Although, yes, we're still in rally mode, but it seems to be encountering that pressure as it climbed closer to 64.30, that being its next resistance band. So it needs to break that before we can extend the rally to maybe somewhere closer to 69. But for now, I'll be more defensive. DMC is also coming into a recovery rally, and it's managed to be able to punch over the 20-day moving average. I would feel heavier resistance closer to 466, and this area should be able to present a little heavier cast in terms of resistance. And if somehow it's lucky enough to punch over that, then maybe 5 pesos and 18 cents. But so far, I don't see momentum slacking off too much here yet. So maybe it could try to be able to reach out into the upper boundary of that. First Jan has actually also done quite well, but it's also managed to be able to lock itself at the 38.2% Fibonacci zone, and it also reached into the 50-day moving average. So we're trying to check if we can see a little bit more rally impact here, because if it can, then maybe it can extend its recovery to about maybe 1980. So just watch it. We should know about what the decision will be here into the next few days. Now, Globe Telecom, just like the other telecom PLDT, have been very strong. They've been quite outliers in terms of their strength, and they punch way above the moving averages. If you notice the signal I was telling you earlier on, its 20-day moving average has already gone above the 50-day moving average. And this is that a more bullish scenario we want to see that confirms my potential reversal. So this is a position you probably want to buy into a correction because this has changed its trend, and the potential for this to move on will be more sustainable than the others. The others might still go through a period of choppiness before they proceed. So I'm looking at potential support between 2100 to 2000 for Globe, as those should be good levels for you guys to be able to watch for potential buys. GT Cap was, took a very, very late game in attempting to make a recovery, but as they saw other issues climb, it started to generate the same thing. But on that same token, clearly there was something hindering its movement and it was not as fluid. So I wouldn't expect this to go too strikingly up into the upper boundary. I would expect major resistance between 500 to 550. So be watchful of that range. ICT, also like Metrobank, also took its time to be able to make a recovery, but at least it's managed to be able to push off. I hope it can reach all the way back to about closer to 92. And I think about there we'll probably see a much more firmer levels of resistance. Do understand that ICT operates a port area, and the cargo services have been stunted because a lot of businesses have been slowed down. So this is the reason why it also did get quite impact into the downside. Now, Jollibee also took in a late rally, but at least this one took in a very strong rally, and it actually hit the 50-day moving average already. But like I said, if you look at the 20-day moving average compared to the 50-day moving average, have not crossed over. So what that means is that although, yes, it's been quite strong, there's a potential this may come back down. So for those who were not able to buy Jollibee in the first swing, you might have an opportunity when it attempts to be able to make a support retest and maybe a higher low. So just wait for that to be able to happen. Current support's between 128 and 108. JG Summit, just like Ayala Land, is also attempting to be able to curve now, and there seems to be some pressure building here. I hope it can extend it to the 50-day, and that being resistance closer to about 60 pesos per share. But I think after that, you'll probably see the correction come in hand. So again, I would really feel that some lightening may be in order here. Similarly, LTG also attempting to be able to recovery, maybe could try to be able to work its way closer to the 50-day, which is standing closer to 8 pesos and 30 cents. But similarly, I can already see some momentum slowing down, and so that means that even if it extends a little bit more, we're probably going to get a corrective avenue in here. So another candidate to be able to lighten into. Metrobank, just like GT Cap, shares pretty similar formations, and it's managed to be able to punch above the 20-day moving average quite late, just like some other banks. And so far, it's managed to be able to pick up. I really hope it can climb all the way up to the 50-day, but I'm really half-hearted about seeing that because it's still quite a distance away. MACD is very negative, and hopefully we really can try to put the pressure off the banks to be able to build a bit more from here. So here, if you're going to try to buy it, I do not anticipate that you be too aggressive here. Just take this one step at a time and don't be too aggressive for the meantime until we can see a pullback in price. Megaworld, just like maybe Ayala Land, is also stretched out. It's come closer to the 50-day moving average, and so I would anticipate resistance closer to 3 pesos and 8 cents. Momentum is starting to slow down already, so we also have to prepare to start to lighten from Megaworld's recovery rally because we may be coming to that phase that we might see a retest. Meralco stronger than the usual issues. If you notice, if I were to draw a downtrend line here, you've seen that prices managed to push above that, and that's a good sign. It's also managed to reach back up to the 100-day moving average, which is not common for most of the stocks we've looked at so far, except from the likes of Globe. And so right now what we want is we want prices to be able to develop a pattern here, preferably not go below 250, because if it does, then it probably widen its correction back to 2 pesos and 30 cents. So if it can hold above 250 and generate a sideways pattern, that should hold and maybe prepare for potential recovery above the resistance of this 100-day. But for now, I probably, if I had a position, I would just lighten down a little bit, wait for the price to see if I can see 250 is not breaking, then I can probably just buy back gradually or wait for a breakout and buy it back later. MPI has not been very solid in its recovery. Um, uh, it could be because maybe the context of the hospitals all being ground up, or its projects being delayed, or the tollways not getting the number of uh, uh, um, car traffic that we're looking at. And that really could be the reason why we've been seeing very much weakness in here. I would anticipate resistance closer to about 290, maybe to about 312. So maybe a rally there first, and then we can see some softening up again. I would really rather see a W base come out of this in gradual time before attempting to go back here. The pure gold, just like Globe Telecom, has done actually very, very well. We saw it shoot up quite strongly, leave the moving averages behind. We do have a crossover between the 20-day and 50-day, just like we did in Globe, and that shows me good trend strength. So what I want to be doing over here is looking for potential entry situation. Now, I think it's a bit overbought on this end, so I want to wait for prices to be able to make a hopefully an ABC correction, bring prices closer to about 40, 50, or 37. Those would probably be better levels for us to be able to look for entry points for pure gold. If it's really strong, it'll just move sideways and eventually break out. So it's something that you want to also keep in mind and just watch for just in case it happens. Robinson's Land has also managed to make a recovery, but seems to be encountering some pressure now after hitting the 20-day moving average. It has not been able to recover back to the 50-day yet, but I would outline resistance closer to about 1750. And if possible, it can break over that and maybe reach over to about 20 pesos. So for now, maybe not need to lighten yet because momentum is still in play here. So if we do see some recovery conditions here, or if we see this break of support of this previous low we have, then that's closer to 1340. Then that's a time that we're going to have to be able to lighten down. Robinson's Retail has also done relatively well. It's managed to temporarily punch over the 50-day moving average, but it did not cross over the 100. And then we just showed this very sharp drop in a recovery. Normally, when you get these sudden drops, it really tells you that people are on the side waiting to sell. And when you see you saw that the drop that we saw a couple of days ago in the index, which dropped about 7%, that already keys in telling you that markets are waiting for this. They're just waiting for all the elements to be in place before they actually come out with the selling condition. So you want to be able to see that these brief moments of vulnerability are showing you there is some weakness still on the situation here, and you have to be very much aware of it. So given that we've seen most of our rally target, might be a good idea to lighten first and then we wait for a wider correction before buying back. I'm looking at resistance 65 to about 67.50 with support looking between 54.90 to about 52.30. Semirara has also managed to be able to make a recovery, and this recovery that we've seen has just touched on the 20-day. If you notice, the fallout here has been quite alarming, and I'm really worried about that. That means in corrections here that volumes are not too good, and it's because of that that you see a very, very sharp decline. So I really don't want to take a chance of waiting for another correction to lighten. I'd rather be selling this on the way up while volumes are still relatively good. So given that we've already come closer to the 38.2% Fibonacci zone, it really might be a good idea to begin a lightening campaign already here first. Maybe if it rallies a little bit more, just go ahead and add to that little bit more of lightening, and then just wait to buy this back later on when it makes its support retest. Security Bank has been quite a disappointment since it's fallen out and now it's going sideways. So here's an example of an L-shaped type of movement, and you see just a flattening. It couldn't even rally. I mean, I hope it happens in the next few days, but if the rest of the market starts to tip over, it might be difficult for this one to be able to counter move with against the rest. So just be watchful of this. It needs to be able to push over 1111 or 1115 to be able to get itself going, then maybe target about 130 if it can actually do that. But right now support is at 100, so just be watchful of that threshold quite well. You don't want to be holding a position that were to crack. Next, we have SM. I think SM has managed to be able to rally quite strongly. This stock is 15% of the weight of the index. And this is the reason that you might be wondering, why are people buying SM with the problems in the malls, or even SM Prime with the problems in the malls and the traffic of their business? Well, it's really because of the heaviness of the index. If people want to be able to buy the Philippine scenario, they have no choice but to be able to put money into these two stocks, and this automatically crossed that lift. And so now we're here trading at the 50-day moving average, and I feel that there is resistance here, and that resistance is closer to about 880 to 890. So again, in this area, you probably want to be looking more for some lightening. If it's, if it can even extend a little bit more to 938, then maybe even there do the same thing, and then we will buy this back when the next correction takes place. San Miguel, just like many of the others, have also taken its time into its recovery. It's still trying to be able to extend that. But right now, maybe we can just trail our movements inside here. Not really too happy on the recovery because I'd rather it be much stronger than this neutral stand that it's doing. Again, I'd like to be able to start a lightening campaign all the way up to about maybe 108 or even 120 if possible. SM Prime was actually also not as strong as SM, again, because people are really wondering, I mean, if there's going to be an extension to the quarantine period and the lockdown, what's going to happen to the malls? And these conditions are easily being factored into the price, and it's the reason why it's been trying to break over its resistance for 4 times now and having a difficult time. Well, it's not out of luck yet because it need to break below support before that would open up a wider correction. But I would feel that heaviness is beginning because resistance was close by at 33 all the way up to about 35.70. Support is at 28.70, so just be watchful of that. Now, PLDT, just like Pure Gold and just like Globe Telecom, are on a very different trend situation. They've shown a break from this downward trend that they've had, and now they're trying to collect their efforts here by making a pattern. That so far is a good stand. And if it can just hold on to this and try to stay above the moving average, and that'd be the perfect scenario. The closer to the moving averages, that's probably a better area for you to be able to look for potential entry spots. Just make sure that if it breaks below these moving averages again, that you can start lightening your campaign. But for now, I really think that the trend situation on the telcos are very, very different. They seem to be in a very stronger recovery streak, and us is Pure Gold. So these are standouts that you probably want to keep your eye on. Potential pullbacks here, you want to be able to buy back on these issues. And finally, we have Universal Robina Corporation, and it's managed to be able to recovery all the way up to the 100-day moving average. So that's actually quite decent. But it has made a pullback since, and I hope that it can stand above 118. But like I said earlier, if the rest of the market starts to make corrections, it's more likely to do it. So I put 2 support points for you to look out, 118 and maybe 110 as a potential buyback situation for URC. I think that into a pullback, that will make a higher low, and that a W type formation is probably what's going to come out of this. So keep your eye on this. Major resistance has been 135 and 147 for URC. Okay, so I've managed to be able to cover all the index stocks for you, and I really want to be able to just make sure that you understand that yes, that after this rebound, that it will not just continue upwards like that. There's just too many things that we have to be able to deal with in the short term that they're still quite iffy. The situation on the virus is still the predominant thing on people's minds. I noticed in the poll question that you guys managed to do earlier on, and I noticed what will you do when they start to partially lift lockdown, and many of you said you're going to stay at home. So just imagine that situation, and what would business be like outside if that's what you're going to do? Because it's just trying to prove the fact that it's going to take some convincing in here to be able to get a normalized effect out in society, and that means it's going to take time before businesses get back to where they were. So how can this oversold rally come back in to become an uptrend immediately? I think it's very hard to be able to factor in. So it will require a second test of support. And like this little comment I have in the screen says, a lie stands on one leg, but truth comes on two. And what I mean by that is after the market makes its first bounce, that one first rally is standing like a pogo stick on a single leg, and that could break. And that's why we need a second leg to step on that support and tell you, hey, this is the second time I tested this support, and this time I'm holding, and the market can show much more better recovery from here. And that is a two-step process we want to see, inclusive of what I pointed out between the 20 and 50-day moving averages as signals that can give you better traction and give you better confidence that the market can start recovering later on. So in anticipation of that, understand what the model would look like so that you can best attempt to be able to maneuver your portfolios accordingly to the structure of the patterns that we were talking about today. So with that, I bid you thank you for attending today's seminar, and I'll open now the round to any questions that many of you would have. Thank you once again.
All right, thank you very much, Mr. Barredo. But before we push through the Q&A segment, we'll take another poll, I think, no? So,
All right.
okay, Lorraine, can we take the poll? Yeah, all right. So let's ask this again. What do you think is going to be the shape of the recovery in the next 8 to 12 months? So kindly select from the responses. Is it going to be a V, a U, a W, or an L? A while ago, the least number of attendees answered a V and an L. I think most of you have expected a W or a double dip recovery, and the second highest is going to be the U-shape uh, recovery. Right. So we have a lot of very interesting questions here, Sir Juanis. I also have some
Okay.
in my bag already. So we'll proceed to that uh, as soon as we finish this poll. All right. Do we have the responses already, Lorraine? I think masyadong matagal. So yun pa rin. I think they're more convinced, sir, that 84% of people think that there's going to be a double dip recovery, a double dip, meaning a retest of the support, and then a full recovery at 84%. So thank you very much for answering that poll. Now let's move on to the questions. Sir, my question is, how important is foreign participation in our markets? Kasi even if the market has rallied since its March 19 low, if we see the index, if we see all the big players, SM, all the way to BDO, with the exception of AC, there has been some foreign selling and significant at that. How important is this, sir?
Well, Ed, I think it's very important because as much as I'd like the local participation to be the carrier for demand in the Philippines, it's still the bulk of buying coming from their side that can generate more lasting movements into our market. So we really do have to see foreign participation to be able to improve to give us better track on this. So yeah, you have to be watchful for this.
Okay, so here's another question from one of our attendees. I think he's just looking for a sort of a recap, sir. So he's
Hmm.
asking, most of the stocks have risen already. Should we buy or wait for the retest of the March 19 lows? I think the most relevant part of the question is, are we expecting to test back the March 19 low? How possible is this, sir?
Okay. Well, there's two parts in this question. I guess the first is the market has risen already, and should I continue to buy or should I wait for the retracement? My
Mhm,
advice would be to wait for the retracement. However, like I pointed out earlier, I really don't think that we're probably going to go all the way back down to that low. And
mhm,
so
mhm,
I am anticipating that a higher low is going to come off this reaction. So it's something that you
mhm,
guys want to be abreast with, because if you're waiting for prices to go all the way back and let's say it only goes half the distance back, will you not buy? And so that's
yeah.
why I think what you do is build a box here. So as the price starts to be able to come back down, you don't have to buy everything in one go. Maybe if you see 30, 50%, 60% retracement of the rally, you can start
Mhm.
accumulating a little your favorite issues.
Okay, so 40 to 60% of
Yeah.
retracement from the March 19 up to where the
From the low we
collection will
have to
be.
this, whatever the high is that you're going to see here. So far we're coming closer to high to closer to about 6,000.
Okay, all right. Wow, that's very valuable, sir. Another question here from a customer who unfortunately cannot stay with us, but she is hoping that this will be included in the recording. The question is, there are looming rumors about a credit bubble burst. How true is this, and is this already factored in the current market movement, sir?
Um, well, it's a fundamental question, but I think a lot of things have been factored in the capitulation swing. And I think that's a pressing worry, and that could be the reason why banks have been very, very weak. Um, I would be asking our fundamental head about those particular pressures that I'm seeing, because normally when I see sectoral weakness, that could mean already that either the foreign investor or local investor are all saying, wait a minute, not so fast on this guy, because there's a pressing worry that it has to deal with, and I think that could be quite it. And I think it's all about how long does this lockdown take place. I mean, if they open these doors within the next by the end of April, or maybe maximum by mid-May, maybe we could still tolerate this. But I think more than that might really be hurting already.
Yes, sir. But I think in that case, only half of us will go out. We won't stay at
That's right.
home.
That's
There's another
correct.
question here, sir. I think very particular about your Elliott wave. So the question goes: is it possible for the fifth Elliott impulse wave down the bottom, the fifth impulse wave to be higher than the fourth wave of the PSEi? If not, then the second leg of the W reversal will be lower than the first leg. I don't think I get the question, sir, but I
Okay.
think,
Well, I think I get the
oh,
gist of what he's asking, or what she's
yeah.
asking. I think the position is that normally when you get a wave five, it produces a
Hmm.
lower low, right? Now,
Okay,
can the situation change where wave five can be higher? And
higher.
the answer to that is maybe not all the time, but yes, it can. Especially
Hmm.
when your wave three, which is the last correction that we've seen, just happens to be able to come in when a panic situation is delivered by by the COVID-19 threat. So in other words, if the wave C was supposed to fall down this much, it actually fell this much. And that means
Hmm.
it priced in more than what it should have. And so
Yeah.
whatever it built in there, you will remove from the next one, because a
Okay.
lot of
Okay.
positions have exited already.
Okay.
So it is
Right.
possible.
It's
So
possible.
really want to see a higher low come in here, because if not, then this will take a much longer time to be able to unwind.
Okay. Okay, sir. Let's pray it already
Yeah.
discounted a lot of these things. So another question, sir, here. Because I think your illustrations of the recovery patterns did not include the time element down there. So the
Mm.
question is, how long will these things take?
Normally, from a level W, it could be, when I say from the one major low to the next major low, that could be an avenue of 3 to 5 months.
Hmm. Three to
So if
five
you look at
months.
the W formation, that could be a 3 to 5 month pattern from one low to the next. And so I
Hmm.
guess
Hmm.
that will give you a sense of how long the consolidation period of a bottoming may be required before we can see better traction.
Hmm. Okay. Before we get into the questions about some particular stocks, here's a question from one of our longtime customers. Ito, can you show the possible hypothesis of the PSEi chart based on maybe 2 to 3? Sorry, can you show the possibility when the intensive lockdown is extended, and second, if it's lifted? Sir, after
I,
April
I,
30, what
I,
can the charts look like when they extend it a little bit further? Another 30 days
I,
probably, or 15 to 30 days.
Well, I think if you were to look at it from the prospect that I showed earlier, right? I said that I'm building in two types of patterns that may frame itself here. One is a
Mhm.
square root type of V shape, or a W, right?
Okay.
So I'm already telling you that it's either one of those two, at least in my best guess. And I'm already
Mm-hmm.
trying to anticipate that there's a potential extension here, because that's what will create the double test. Because if there is
Mm-hmm.
no extension, they release everybody. I think no one is anticipating that. Many of you,
Uh-huh.
for example, you, Ed, you're not even going to go out of your house, But if the government is telling you already, okay, we're not extending, and people get the sense that this is not as bad as what we thought, and I think they will react very differently, and you probably get something much more vibrant in terms of a market recovery. But I'm already factoring in we are going to see a potential extension here, and that people out there will show their own extension by not going out. And that alone should be able to allow this recovery period to last in that 3 to 5 month period that I'm talking about.
Okay, sir. So 3 to 5 months.
Mm.
Okay, so next question is, I think, bordering some clairvoyance, sir. What could possibly trigger the next support test? What event could possibly
Um,
trigger?
I think I put a slide up earlier on to try to do that, right? I think one to do a support retest, I think one big factor that can do it is second quarter earnings results,
Mhm,
right? Because a lot of people are seeing first quarter results, and I think they're only half bad because the first part of the year did not encounter this yet. We only started seeing this from March. So now that you're seeing the first quarter, and it did show some slowdown, but it didn't factor in the full slowdown. And I think you'll only start to see
mhm,
that at the
mhm,
end of the second quarter. So that means you'll have to wait for the end of the second quarter to be able to see that. So we're talking about maybe um, after June. July area is
mhm,
where you're
mhm.
probably going to see the impact of how people will react to that. So that could cause a retest. The second thing that could do it could
Okay,
be a second wave. A second wave in terms of a
okay.
resurgence in COVID cases. Maybe if they release things too quickly and it is not controlled,
Mhm,
and people out there start to be able to venture forth and they reinfect one another, that in all the second cases that we've been seeing, even in history, they've showed that second case or the second wave sometimes can prove to be even more nasty than the first.
mhm. Okay, okay. All right.
So that could be a potential
Ooh,
situation happening. So it could be earnings driven, it could be virus driven. God forbid anything happens in between.
okay. Sir, here's another question with regard to response to this rally. Is it wise to buy the laggards in this current rally from the March 19 low?
I would say yes, but like I said earlier, you probably want to tone down on your portfolio size with those laggards, because first, if you think they're only lagging because of certain reasons that may not be too extensive, then yes. For example, uh, if you're concerned about banks, for example, will continue, then that could be the reason why they were lagging in the rally. But for example, people were asking me before, how come Jollibee was not rallying, where Pure Gold was rallying? And well, it could be because remember, they operate a restaurant business. You have to go to their site because majority of their revenues come from there. Yes, they do have delivery services, but that might be a small component of the revenue stream. And maybe it took some while, and maybe you had to show people that maybe there could be a bit more better recovery action before you get something going. So my standing is that if you're going to go for the laggard, please don't put a big chunk of your portfolio in there. Your big
Mhm,
chunk should come from the worthier issues that you can see that maybe it's not being affected too much by this. They've already shown you stronger trend formations, or in the initial wave, you've already seen good recovery swing action. That tells you volume will go back to these guys. So that will be my priority. Then maybe if you want 20% of your portfolio, you can go for the laggards.
okay, all right, sir. The next two questions are pertaining to stocks. We have two. So if Lorraine can shift again back to your charting app, sir. So the first question is, what do you think about Wilcon, sir?
Well,
Mm-hmm.
if you look, can you see my screen now, Ed?
Yes, sir.
Okay. So Wilcon has done a relatively good base. It's managed to climb back up to the 50-day EMA. So I think it's worthwhile. If you have it, you might even look to target, if not this, maybe all the way up, if it's strong enough, maybe to 1616 or 1615 as a potential target for Wilcon.
Mm-hmm. Mm-hmm.
Um, do understand that their business is also being affected by this situation. So you probably, if you see resistance here or into the next level, you really want to probably take profits first and then wait for the next pullback to be able to buy Wilcon, because this would have been the ideal entry right here. And since if you
Okay.
missed that boat, then you're halfway through. We may have a little bit more. So if you have it, then maybe take profit somewhere between here and here, then wait for a buyback if it can pull back between this area, maybe even back to 1250 if possible.
Okay. Next company that our customers would like you to look at, sir, is IMI. Ooh.
Okay, so IMI has actually done well in its recovery. It's actually broken off above this, but please look at the longer term picture here, okay? Because this may affect you later on. And so this is the reason why you're probably feeling some pressure close to this area here. We have major resistance between 750 and 760. So I think it
Mhm.
can try its best here. It would be nice if it prepares a pattern here, but my thinking, this can run illiquid on the downside. Just wait for the next reaction if you're attempting to be able to buy IMI. Look to take profits between 7 to 750.
Okay, sir. Well, I think we have three more stock questions. So
Okay,
here's
go ahead.
another for CNPF, sir.
Okay, I think this has been doing well because of the industry it belongs to. I guess it's a bit more resistant than the rest, being in food. However, we are coming to a major resistance area, which is closer to between 15 to 1550. So the risk reward coming as an entry point now might not be too good. I would rather wait for a reaction to get back into CNPF. If I had it, you might want to look to lighten between 15 to 1550 first, Ed, or maybe even maximum 16, and then just wait for prices to be able to pull back.
Mm-hmm. Okay, sir. Lastly, ito naman sa mga tinamaan ng recent ECQ. A customer is asking, how about EI and Megawide? Now, given that, are these stocks okay to buy for the long term, sir?
For the long term, I don't think I'll have a problem with these companies because I think once the lockdown comes in, things should start to normalize. Right now, I'm in EI construction and deployment company. People cannot go to work, people cannot build. So this is a reason why you can see it's taking some time. But it looks like here's an example of a laggard that might continue. So if you're going to be buying something like this, just put a small amount of your portfolio. Your target is to get in here and maybe exit somewhere closer to where this red line would be, and then just wait it out again.
Mhm.
Was Megawide the second one?
Megawide.
Megawide,
Megawide,
sorry.
sir. I'm wide.
Okay, so pretty much in the same boat, but please look at the long-term chart here. This is a gigantic head and shoulder formation which fell down and tried to make a recovery. So again, if you're looking for a temporary bounce maximum, maybe closer to about 970, 980. And do take your profit inside here when it happens because I do believe that after that this will make a reaction, and these are very illiquid stocks, so you don't want to get stuck in an illiquid stock when in corrective period. So be a little bit more discerning about these.
All right, sir. Thank you very much. That's all the questions we have from our customers. So again,
All right, thank you too.
thank you. Thank you, Mr. Barredo. So for those
All
of
right,
you who are
thank you everyone.
not able to catch its entirety, we will be publishing the recorded version of this that you can share with your friends and your family. So there you have it, everyone. Thank you again for joining us in this afternoon's session, and have a great day. Thank you.
Thank you.